Hello everybody, welcome to the part 2 of the video on investment banking interview questions and answers from Career Guide. In today's video, we'll see some very basic and important questions on financial modeling, usually asked at the interviews. In part 1 of the video, we covered the questions on valuation methodologies. The link to that video is available in the description box below for you to see. Other than this, these videos on basic accounting and financial analysis will also be very useful to you. The links are again available in the description box below. You can watch these videos one by one after you finish watching the current one. These videos have already helped thousands of candidates. They'll surely be useful to you too in cracking your next interview. So, ready to begin? Fantastic. Let's start. Okay, so here comes our question number 1. What is financial modeling? Now see, if financial modeling is a part of your job profile, this is one of the basic questions you must be prepared to answer. So, to answer this question, you can say, financial modeling is a quantitative representation of a company's expenses, earnings, and other business aspects in the form of a spreadsheet, and in a way that can be used to forecast the company's financial future based on the assumptions and past performances. Now, you can further go on to add, financial models are used for various purposes. For example, to decide on the budgets, valuation of a business, compare the business to peers, to raise the capital, grow business organically, corporate planning and allocation of resources, then strategic planning to test various scenarios. If you want to sell or divest business units, you use this financial modeling. To carry out the due diligence, you use financial modeling. Then, to explain or anticipate the impact of various events on a company's stock based on its internal or external factors, you use financial modeling. Equity research, portfolio management, and then lastly, for the calculation of the cost of a new project, you use financial modeling. So, these are various purposes for which you use financial modeling. Now, adding this extra bit of information about the purpose of financial modeling starts setting the tone for the interview. It also helps you stand out from the crowd, because most of the candidates will answer only what's asked. But actually, it is these extra pieces of information that gets the interviewers interested in you and they try to find out more about you. Okay, so let's move on to the next basic question that you must be prepared to answer. Okay, so let's move on to the next important question that may be asked to you. And the question is, what are the most important components of a financial model? Now see, like any other thing in the world, it is the components of a financial model that decide how successful or effective is it going to be. Some of the most important components of a financial model that you should talk about to answer this question are, number 1, the assumptions. That is, the assumptions about revenue, expenses, discount rates, capital expenditure, all form the basis of a financial model. More accurate are your assumptions, more effective will be the model that you build. The second important component is the historical data. Since you are trying to predict the future based on the past, your data has to be accurate. The third one is the 3 statements. That is your income statement, balance sheet and cash flow statement. The fourth important component is the supporting schedules. These are the schedules to your main statements, such as depreciation schedules, debt schedules and working capital schedules. Then your valuation technique is very important. It could be DCF, CCA, precedent transactions analysis, depending upon the case you are dealing with. And the last component that you can talk about is sensitivity analysis, as it analyzes the impact of changes in the key assumptions on the output. If you take care of these 6 components, your chances of creating an effective financial model increase many folds. And these are the important things that you must cover in your answer to this question. Okay, let's move on. Okay, so moving on to our question number 3 now. If you were to create a financial model, how would you go about it? Now see, the question is basically asking you, what steps would you take to create a financial model? A very basic and important question that has high chances of being asked at any interview. Following are certain important steps that you should talk about to answer this question. The first one is gaining the business knowledge. This is very important. This is the knowledge about the company, its business, financial factors, domestic and global factors, competition, key drivers, etc. Then you try to understand the objective of the model. That is, why are you creating that model? Are you trying to determine the financial future of a company? Or are you trying to determine the impact of market events on the stock, valuation for selling or buying, or anything else? What is your purpose? Then, based on that, you start gathering the data. Historical data that exists in various departments, financial data, data from the market research, or anything that you would require. You also have to think what can be the sources of this data. In your next step, you start creating the model structure where you actually start setting up the Excel sheets. Then you calculate the ratios and assumptions. These can be P ratio, PB ratio, EBIT margin, debtor and credit ratio, etc. Basically, all the ratios and assumptions you're going to use in your model that will help you predict the future. Then you prepare your financial statements, that is your PL&D statement, balance sheet, cash flow statements, and supporting schedules also, like depreciation schedule, debt schedules, working capital schedules, fixed asset schedule that provide additional details and validate the financial statements. Then you try to link all of these documents and make the predictions. And lastly, you perform the sensitivity analysis to understand the impact of change in the key assumptions on the output of the model. Once you have seen the sensitivity analysis, you try to check for any mistakes that might have happened. These can be the conceptual mistakes, the mathematical mistakes, etc. You correct them and perform your sensitivity analysis again. And lastly, you validate the model and give the results. So you see, when you talk so much in detail about each step, definitely the interviewers are able to trust your understanding. And they try to dig deeper and ask you more questions so that they can find out if you are the one they want to hire. And these type of answers, as I have been saying, they require preparation. For that, you have to think about them in advance, right? So preparation is the key here that helps you stand out of the crowd. Okay, so just now we talked about the importance of gathering the data. Now your next question could be about that. And the question could be, how would you go about sourcing the data? Because this is very, very important. Basically, the question is asking you, which resources would you use to get this data for your financial model? Some of these are the resources that you would definitely require, while others can be as per the objective of the model. These resources can be majorly companies' financial reports, quarterly, annual, stakeholders, investors, all kind of reports can provide you the data. The second one is the presentations and press releases that the company's management has made. Your third resource could be private market research reports that can tell you about the competition, market growth, any factors impacting the global or domestic market in the near future, etc. Then there are government databases and reports that you can use. Reports by industry associations can also give you a good insight. And the reports by independent research bodies can also be a very good source of information for you. Okay, now pay attention. The next question that's coming up is really very important. And the question is, what are the qualities of a good financial model? Why is this question important? Because someone who is aware of what a good financial model looks like is always more likely to build one. That is why this question is very, very important. If I were to answer this question, I would say my mantra of a good financial model is FAST, where F stands for flexibility. And this flexibility means flexibility in the structure and style of the model, both. You would require this flexibility for immediate and the long-term use, both. The second one is A, and that stands for appropriate. Appropriate to the purpose. It should use key business assumptions without being cluttered with unnecessary elements and details. These unnecessary elements and details just make the model clumsy, complicated, and difficult to use. A really good model is simple and user-friendly. Then S stands for structured. This means consistency in the layout, presentation, and organization. It ensures that the model is easy to understand and usable even when its authors change. And the last one, T, it stands for transparent. With simple, clear formulas that can be easily understood by the modelers and non-modelers alike, my model would be transparent. Using this fast approach keeps the things clean and auditable in the spreadsheet. And in addition to all this, the model should be scalable, which means if you want to build on it, it should allow you to do that in the coming years. Okay, now in our question number 3 just now, we talked about schedules. Your next question can come from here, and it could be, what do you mean by a schedule? To answer this question, you can say, a schedule is actually a supporting report or document which constitutes detailed information about the elements of the main financial report. So you can say it's a supplementary document, worksheet, or a table that is used by accountants and bookkeepers to organize, summarize, and analyze the financial data. For example, your debt schedule will have a list of all the outstanding debt obligations like loans, bonds, and lines of credit with detailed information about the principal amount, interest rate, maturity date, repayment schedule, and any other terms and conditions associated with each debt instrument. Okay, let's move on to question number 7 now. What are the key drivers in a financial model? Now see, key drivers are the specific factors or variables that have a significant impact on how a company or business performs. These factors may differ from business to business and company to company also. For example, if you consider two different retail chains, the number of outlets could be a key driver for one, while the number of exclusive products or premium pricing could be the key driver for another business. These drivers also depend upon the purpose of the model. The deeper and clearer is your understanding about these key drivers, the better your model will come out to be. Some of the common key drivers usually taken into consideration while building a financial model are revenue, pricing, operating cost, tax rates, capital expenditures, etc. Okay, moving on to question number 8 now. How would you forecast the cost? Financial modeling is actually all about forecasting. So again, a very important question. And see, it's not just about the cost. Whichever element you may want to forecast, the most important thing is identifying the key drivers that drive it. Also useful is analyzing the past trends and making informed decisions about the future assumptions. So actually, this one answer can help you answer many other questions also. For example, in this particular question, we are talking about the cost. So your first step here would be to analyze the past trends. See if there are any patterns. How has the seasonality impacted the cost in the past? Is there anything worth noticing about the expenses, operating and capital, both, and other such things? Then identify the drivers. This may comprise factors such as production volume, labor cost, material prices, overhead expenses, inflation rates, regulatory changes, technology advancements, etc. And then you make informed assumptions about the future. Conduct your own research using the various resources that we discussed in above question number 4 just now. So these are certain things which determine how effectively you forecast the cost and other elements that may be a part of your financial model. And finally, the last question for today's video. What is the impact of depreciation on a company's operating cash flow? Now see, depreciation is actually a non-cash expense as it does not involve an outflow of cash. It just reduces net income on the income statement, but it is added back to the net income when calculating operating cash flow. So what actually this adjustment does is, while it reduces reported profitability on the income statement, it does not affect the company's cash position or its ability to generate cash from the operating activities. Rather, it increases the operating cash flow. So friends, these were some basic and frequently asked questions related to financial modeling that we talked about. You must be prepared to answer questions on basic accounting, financial analysis, valuation methodologies, mergers and acquisitions also during the interview. The links to all these videos are available in the description box below. If you're really serious about cracking your next interview, make sure you watch each one of them. If you found today's video useful, do give it a thumbs up and share it with your friends also. To stay updated with more such videos, subscribe to the channel now. I'll see you very soon with a new video. Till then, bye-bye and take care.